Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, I want to reevaluate GameStop's hardware business valuation in light of their very disappointing hardware sales from quarter 3. Previously, I had modeled this as a weighted average $4.7 billion value of a business. Let's go through those assumptions and reevaluate because I imagine there's going to be some substantial changes with this one. Before I get into it, thank you to those who have subscribed. We are on a march to scale Mount Fuji together, aka to reach 3776 subscribers. If you want to be a part of the Pokemon, aka Sub Club, would love for you to be a part of it. Also, thank you to those who have joined, and congratulations to those who have joined as fans and friends. Added perks, added advantages, including access to my GameStop spreadsheet. Okay, so first off, on the SG&A front, I had, again, I baked in the continued cost cutting of SG&A. I'm getting more conservative with my valuations and just baking in the present trailing 12-month SG&A, maybe baking a little bit of Q4, right? That total pie is really more like a $900 million pie. And the hardware portion of that SG&A is really probably more like 55% rather than what I had at 50%. That's because on a revenue basis, while hardware may end up at about 50% for the full year, the software sales have a chunk of basically SG&A free revenue, which is their digital software sales. And hardware, obviously, there is some refurb costs related to the used hardware business, more so than probably software. All that to say, I would say SG&A is more like 55% of 900 million rather than 50% of 800 million, which puts you at 495 rather than 400 of SG&A. On the revenue, this has to come down a ton. Okay, right now, GameStop's trailing 12-month revenue for hardware is 1.3 plus 7, just over 2 billion in trailing 12-month hardware revenue compared to what was 2.6. Now, this is the floor case scenario that we're talking about. And so, do you want to say that the floor is 2 billion? Probably not, because we did see a year-over-year decline from Q3 to Q3, right? Q3 last year was 417. Q3 this year, 367. Now, a lot of that was pent-up demand in Q2, right? If you take the combined Q2 and Q3, you were at 960 million in sales in 2025, whereas in 2024, you were at 868. So you actually are growing, or did grow, if you combine Q2 and Q3. And despite having over 1,000 fewer stores than you did in Q2, Q3 of 2025. So there's certainly some reason to believe that around a $700 million quarter is very possible, right? In Q4 of 2025. But again, that still puts you at 2 billion rather than the 2.6. Now, let's say they do not, right, quarter over quarter. Last year, there was a 315 or $305 million bump. No, yes, $305 million improvement Q3 to Q4. I imagine that on a dollar amount basis will be achievable this particular Q3 to Q4 as well. Again, with the new console cycle, that would put you at 672. But let's say you only get 600 and that your worst case on a revenue basis is really like a 1.9 rather than 2.6. What are the margins that you're going to get? Well, on our margin tab, we break this down every quarter. And really conservatively, they're still crossing that 25% mark on the hardware line. In Q2, it was so new console heavy that it got down to 21. But before that, it was at 26. So again, on a weighted average basis, if you want to say that, conservatively, they're going to average a 23.5% margin, or you could just call it 23. I think that's plenty of reason to think that that's kind of a floor case scenario when really statistically they're at like 25, 26 typically. The thing is, though, with these assumptions, they end up with negative income, right? If you assign 495 of SG&A to the hardware business, they only make 1.9 billion in sales and they have margins at 23%. They're actually losing on a net basis 58 million per year, which is very unlikely, right? Now, what are some like it's almost positively not the case. GameStop is a lot running at a loss on hardware just for the benefit of selling some collectibles and software. I think that's very unlikely, but is it possible in a floor case scenario? Sure. But we want this scenario to be reasonable, not what if an asteroid hits every single GameStop store, but really what is very, very plausible, very likely. If we assign 150 of SG&A to software and 495 to hardware, that would leave that's 645 of the 900, which would leave what, 255 for collectibles, which would be what, 28% of their SG&A. That's probably a little low for collectibles when we know that at least in Q3, collectibles was 31% of sales, right? So the trending direction of GameStop's SG&A is that collectibles is a larger piece of the pie, right? So maybe we're a little aggressive on the SG&A number, and we say, what if we make that 50% rather than 55%? And on the margin number, what if we make that 24% rather than 23%? Then you basically have a break-even hardware business, which is certainly the floor, right? In this scenario, GameStop is only selling consoles to get customers to then sell the customers games and merchandise, which there's an argument to be made. This is plausible because that is how Nintendo runs, right? They sell their consoles at a razor thin margin so that they can make money on video games. So is that basically de facto passed on to GameStop? Hey, you can be our distributor for these consoles, but you're not going to make any money either. You're going to have to make your money on all of the rest of your business. Sure, right? And again, 19 is really more like 19.5, even if they only make 600 million in Q4 or 625, that's really like 1930. So again, does that move the needle a little bit? Yeah, sure. But it's a moot point because really you're talking about a very, very negligible income. Now, what kind of growth would you assign to it? The total hardware business is growing, right? As each console comes out, there's more total consoles in existence in the universe, right? And the video game sector, the console sector, is a growing sector. But GameStop's store count is declining, right? But GameStop's efficiency is increasing with the store count decline. And right now, with GameStop's retail business, we're valuing it on a PE basis, not on a price to sales. We're valuing it at some multiple of earnings. And as we saw in their most recent quarter, even though hardware on a top line came down a little bit year over year, right, about a 12% decline year over year, their hardware per store actually grew by 47%. So the amount of hardware that's being sold online is increasing meaningfully. In other words, it's kind of like every store or every two stores they sell, they retain one store's worth of customers. I don't know if the math of that's actually legit, but that's kind of how I'm thinking about it. All that to say, is there any reason to think that they will devolve from a efficiency perspective? Like, can they maintain some type of margin to at least break even? I think that much is basically certain because they are moving in the right direction as far as efficiency. You should see this income number actually growing, but in a worst case scenario, let's say they're lowering their SG&A over year, and they're increasing percent of sales coming from online and therefore increasing their sales per store year over year. Let's say all of that is just keeping pace with the lower top line sales number. And then let's say that the console cycles get wider and longer, right? So, yes, consoles overall are kind of growing, but with GameStop's efficiency is increasing. But if there are some lulls, if there are longer, you know, ditches of time, right? Periods that last for years where customers are really looking for consoles, again, that hurts GameStop's top line substantially. In this floor case scenario, that might actually help them because that many more people are potentially going to be shopping for used consoles and trading in, which GameStop has higher margins on. But I think overall, if you're GameStop, you'd rather new consoles be coming out all the time and for there to just be more and more demand for more and more video games. And potentially, as consoles get made newer and newer, right? Maybe it doesn't trend that way, right? So overall, growth. Is there a scenario where basically there is none? It's just flat. Despite the industry overall rising, despite the efficiency increasing, there's just not enough margin to go around. There's not enough new consoles to go around. And consoles are just the loss leader, the big ticket item that gets people in the door, but there's no real underlying net income growth over time. Sure. In a worst case scenario, sure. What kind of PE would you give a hardware business with no growth, razor thin margins? I mean, you would not give it a large PE, right? You would certainly give it a discount to the overall market averaging 30. And you say, hey, for this business, if it does lead to software sales and collectible sales, there's still some value there, but you'd place most of the value on the software and the collectibles portions of the pie. And right now we are dividing up the pie intentionally to understand them as a sum of the parts business. If their PE is 15 on 6 million of net income, this is a $90 million business, right? Now, what are the odds that this is only a $90 million business? I mean, pretty low, but that sales number is fair. The SG&A number is fair. The margins number is fair, right? And so, again, do you want to call this a 20? Sure, now it's a $120 million business. At a certain point, you're just talking about the business that creates the business. So the value created by the hardware business in this scenario is represented by the value of the software and the collectibles businesses rather than the hardware business itself. You tracking? Alrighty. Let's let's move on. Let's call this the floor. The odds that this is the floor, 15% feels a little bit high. I want to call it 10, to be honest. but I might go back and call it 15. But let's look at the fair case scenario. Fair case, basically you're looking at 1950, or you could say maybe 1975 as far as full year income is concerned. It really comes down to, obviously, what do you think? Yeah, 1975 would mean a $670 million Q4, which is, slightly more than Q2, but not substantially so. Although some reports indicated a pretty soft November for the Switch 2. So I might even want to come down a little bit on that and call it a 1950 fair case as far as top line sales is concerned. Um, on the margins piece, you could basically go up to 25% rather than 24. On the year over year, or sorry, on the income. Oops. Let me go here. Now you're looking at 38 million in income rather than 6 million. On the growth, right? Which the growth is not technically factored into the valuation, but is a indicator for what type of PE do you give it. And basically, if we could say 5% growth, what type of PE then do you ascribe? 25 is probably still a little rich, right? Maybe you're looking at a 20. And basically, we're bringing the hardware business way down from where it was. Right now, we're saying this is a $750 million business rather than a $3 billion business in the fair case scenario, and probably increasing the weight here too. Now, here's the thing. This 5% growth number, we will see a year from now how this ages. My assumption is that despite top line coming down, income will actually rise faster than 5% worth. Right? This 5% growth is an income growth number, not a sales growth number. And if you were to take the income of the hardware business in 2024, you're looking at 3.8 million in sales. Well, that's total, but 55% of that being hardware, right? About 2.1 billion in hardware sales. But you're also looking at 55% of SG&A, which is something like 600 million. That 2100, if they're getting back then, probably more like a 24%, 25% margin, that's 525 million in profit. But then you take out 600 of SG&A, and you're looking at a $75 million loss in their hardware business in 2024. So again, what does that mean? Does it mean that, first of all, is this floor case scenario possible? Yes. In 2024, hardware probably still was unprofitable, right? They had a full year operating loss, right, for the company in 2024. So, and what's the lowest margin portion of their business and the highest portion of their sales? Hardware. So, what's happening in 2025 as operating income is finally flipping positive? Well, software is breaking through first. Software and collectibles are breaking through, and hardware is probably the lagging portion of the retail business. Again, it's probably the milk and eggs, right? Get the customer in the door. We've got your consoles, but we're going to make our money selling you other things. But now they're actually making money selling those other things. And the improvement year over year is probably pretty noticeable, right? This 2.1 goes to a 2 million, but the percent of sales and the percent of SG&A is coming down meaningfully, right? This number is probably going to end up being 50% rather than 55%, right? And the SG&A number is going to be like 900 instead of 1100. So you do the math and it's like, okay, we're moving in the right direction overall. Um, and the year over year improvement of that is substantial, right? We're talking about a $6 million net income for a business that a year ago was a $75 million loss, right? Are you tracking with me? So what do I mean when I say this growth number? I'm saying their year over year net income growth from the hardware business is huge, right? But the reason why you're not putting a high multiple on that is because it's driven through cost cutting, which means it's probably not indefinitely sustainable, right? You can't have huge profitability spikes every year forever just from cost cutting. There has to be underlying sticky demand, delighting customers, right? You have to build a presence as a retailer that snowballs for you in a meaningful way on the top end, not just profitability on the bottom end. But we're valuing it based on profitability on the bottom end. And my guess is that the growth of the income is really probably more like a 10% than a 5%. And the worst case is probably more like a 5% than a 10%, because the cost cutting opportunities are huge, right? If they can see an 80 to $120 million swing in net income from the hardware business in 1 year, well, if they can just move the needle a little bit, right? If the baseline is $5 million of profit, well, if they make 10 million next year, that's 100% growth, right? You know, and if they make 15 the next year, that's another 50% growth, right? The growth numbers will look gaudy while it's so small. So you're kind of thinking about the cost cutting along with what does the top line look like, etc. In the worst case, you know, do you give this a slightly higher valuation than a 15? I don't even know. I might just leave it there. But again, that's why I'm calling this a 10%, because the odds that they have zero net income growth is very low to me. The odds they have 10% growth is not unreasonable at all, despite the top line potentially coming down for a few more years while they continue to cut stores. On a PE basis, I would probably call this a 25. A 30 is an average for the S&P 500, and the S&P averages about an 11% growth on net income. So there you have it. Your kind of fair case, right at about $1 billion business. The fly case scenario, we're still looking, I mean, you could call it 2050 if we just have a huge blowout Q4. What would need to happen in Q4 to hit 2050? You need to hit 745 in total sales. So a $20 million improvement year over year with far fewer stores. But obviously you have the Switch 2 on your side. And you did see between Q2 and Q3, 868, 959. You saw about a $50 million improvement per quarter, or a $100 million improvement Q2 and Q3 combined. So a $20 million improvement year over year, Q4 to Q4. Not impossible by any means. The margins, let's get a little bit more. I mean, it's fine if you want to call this a 26%. There's no like huge bull case for the margins other than used consoles have higher margins than new consoles, right? What's the income on 26% margins with their SG&A? $83 million in this fly case scenario. We are giving this a 20% weight for now, and then we'll reevaluate as we're wrapping it all up. What type of growth do you put on their video game console business? I mean, again, they're with the hardware, it's a tough place to value because you just have to see how this number continues to convert. Hardware sales per store, and how low does the store count get, and how much does that bring down SG&A, right? So there's a lot of unknowns valuing a business that's in the middle of substantial transformation, but all signs are that their cost cutting yields meaningful returns on their income. The second assumption you'd have to make is that after their cost cutting period of time is done, that they are able to then expand their revenue, right? They can put money into advertising, into new hardware related businesses, whether it's computer related, whether it's VR related, whether it's accessory related, controllers, headsets, fitness bands, Apple Watches, the phone business, the laptop business, right? Could they grow their top line when they decide to after they're done moving the needle through their bottom line? Because we don't know, no, but it's likely that they show net income growth for their hardware business, right? Operating income growth for several years that are in excess of 20%. So then it's just where do they age out after that, right? So, a lot of that comes down to how is GameStop perceived as a retailer down the road. But overall, tech and tech wearables, laptops, microphones, headsets, like, do we see a society that has less demand for that in the future? It's really pretty hard to imagine. So when you combine that with cost cutting, could you imagine a 15% growth? Sure. If that felt too aggressive and you wanted to call it 13%, fine. It doesn't really matter because this is really several years away. The next couple years, it's going to be more than 15%, right? All we're really arguing about is can they, once they finish moving the needle through cost cutting, can they grow the top line of their hardware business, right? That's the conversation. And we're in the middle of a console cycle that's going to be 4 years long. That's wind and GameStop sales. So it's going to be 5, 6 years before there's pressure on GameStop to grow the top line in order to grow net income. They're going to be able to grow net income at 15% for the next 4 years just through their console cycle and their cost cutting, really probably more like 20% plus, right? And who knows what's going to happen 5 years from now, right? 15% seems pretty conservative, pretty reasonable, even in a fly case. I maybe even want to call this 20 because I think the ramp to grow at 20% for several years is very real. But let's call it 15, but then give it a more meaningful PE because the security of this 15 is relatively high, right? So if you called this a 38 rather than the 30 that the S&P averages, then that would give you a kind of a fly case valuation of about 3 billion. Now you could also increase this or lower the PE, but assume that the growth will be higher. Or if the growth is higher, really that would bring the PE even higher, you know. Regardless, we're looking at about a $1.3 billion weighted average hardware business that we're thinking of now in light of, hey, get people in the door, have the high ticket item that people want, and then sell them other things that they will buy. Ultimately, that'll be reflected in their software and collectibles. Together, their software business at a 2.1 and their hardware business at a 1.3, you're looking at a $3.4 billion retail business so far, not having on a weighted average basis, and up to realistically, plausibly, right, maybe a $7 billion retail business. So somewhere between a 3 to a 7 without factoring in collectibles yet. And of course, without factoring in power packs, without factoring in their cash on hand. And overall, this is a company that is trading at below just their cash on hand. The floor case scenario that we're looking at so far, you're looking at a $1.4 billion retailer so far without having yet factored in their collectibles business. Excited to get into that one in a video soon. Scrapping power packs from the collectibles valuation, looking at collectibles just as the retail operation and looking at power packs separately. I kind of want to bring down, since I gave this 20% weight, I kind of want to bring down the PE on the fly case. But if they are growing faster, I mean, 38 is still more than conservative if they're growing at 15%, right? So anyways, but just shedding a little bit there. Shedding a little bit. All right. And again, it's a PE of 35, but we're just talking about 83 million in net income. So whatever way you want to slice it, if you just look at the actual cash generated, the break even, if you're, paying for this business for $3 billion, but like its net income a year from now is 120 and then it's 160 and then it's 180, right? It's not long before you actually are at a break even pace. All that to say, even if you brought this down to a 29, you're still looking at a $1.1 billion average valuation, right? All righty. That's all I got for y'all today. Hope you enjoyed it. Let me know if you did in the comments, if you learned anything. If you got anything else you want to add to the hardware equation, the milk and eggs of GameStop's grocery store. All right. I will see you in the next one.